Picture this. You finally found the apartment. Great location, reasonable rent, close to work. You fill out the application, pay the fee, and then 3 days later you get the email. Application denied. And the reason? Your credit score. Or maybe it happened like this. You walked into a car dealership. You did your research. You knew the exact car you wanted, the fair price. You even got pre-approved for financing. But when you sat down with the finance guy, he came back with an interest rate that was 2, maybe 3% higher than what you expected. And when you asked why, he just shrugged and said your credit score was a little lower than they hoped. Here's the thing. That 2% difference on a $30,000 car loan over 5 years. That's an extra $1,600 you're paying. For what? Because some algorithm decided you were slightly riskier than the person sitting in that chair before you. And the worst part? You probably don't even know why your score is what it is. You've never missed a payment. You pay your bills on time. You're responsible. So why is this 3-digit number quietly making your life harder and more expensive? My name is James, and I spend way too much time thinking about credit scores. If you're someone who feels like you're doing everything right but still getting punished by this invisible financial system, hit subscribe and give this video a thumbs up. Because today we're going to break down exactly why your credit score might be sabotaging your financial life without you even realizing it. Now look, I'm not here to tell you that credit scores are some evil conspiracy designed to keep you poor. They're not. But I am here to tell you that the way most people think about credit scores is fundamentally broken. And that broken thinking is costing you real money. We're talking tens of thousands of dollars over your lifetime, maybe more. So let's start with the basics, because even the basics are misunderstood by most people. Your credit score is not a measure of how financially responsible you are. I need you to really hear that. It's not measuring your responsibility. It's not measuring your income. It's not measuring your net worth. A billionaire could have a terrible credit score. Someone with $50,000 in debt could have an excellent one. Here's what most people don't realize. Your credit score is a measure of how profitable you are to lenders. That's it. The entire system was designed by lenders, for lenders. The score is essentially predicting one thing and one thing only. How likely are you to pay back borrowed money, with interest, on a timeline that benefits the lender? This is where it gets interesting. The person who pays off their credit card in full every single month? The financially responsible person who never pays a dime in interest? The credit bureaus actually have a term for people like that. They call them deadbeats. I'm not making that up. In the industry, someone who doesn't generate interest revenue is literally called a deadbeat. Now think about what that means for a second. The system that's supposed to measure your financial trustworthiness considers the most financially disciplined behavior to be economically undesirable. That should tell you something about whose interests this system really serves. But here's where it starts actually ruining your life. Because credit scores have escaped from the lending world and invaded everything else. Landlords check your credit score. Employers check your credit score. Insurance companies use your credit score to set your rates. Cell phone companies check it. Utility companies check it. In some states, your credit score can even affect your dating life because, yes, there are apps where people share credit scores like it's a personality trait. So this number that was invented by lenders to measure lending risk is now being used to judge your worthiness as a tenant, an employee, and apparently a romantic partner. And the crazy thing is, these other uses don't even make logical sense. Let me give you an example. Studies have shown that credit scores are weak predictors of job performance. There's almost no correlation. A 2012 study found that there was essentially zero relationship between credit scores and job performance or workplace deviance. But 60% of employers still check credit during the hiring process. They're using a tool that doesn't work for the job they're using it for. Same thing with car insurance. In most states, your credit score affects your insurance premium. Someone with poor credit pays on average 29% more for car insurance than someone with excellent credit. But here's the thing. Your credit score doesn't measure how safely you drive. It doesn't predict accidents. It's just another way to charge certain people more money. Now you might be thinking, okay, James, I get it. The system is flawed. But what am I supposed to do about it? I still need to rent apartments. I still need to buy cars. I still need insurance. And you're right. which is why we need to talk about how this system actually works and how you can game it in your favor. There are 5 factors that determine your credit score, and understanding them is the first step to stopping this number from ruining your life. The biggest factor is payment history at 35%. This one is straightforward. Pay your bills on time, every time. One missed payment can drop your score by 100 points and stay on your report for 7 years. 7 years for one mistake. Think about that. The second factor is credit utilization at 30%. This is where most people mess up without even knowing it. Credit utilization is how much of your available credit you're using. And here's what most people don't realize. Keeping a low balance is not the same as keeping low utilization. Let me show you what I mean. Say you have one credit card with a $5,000 limit. You use it for everything and pay it off in full every month. Responsible, right? But if your balance is $4,000 when the statement closes, your utilization is 80%. And 80% utilization tanks your score even if you pay it off completely. The credit bureaus don't care that you paid it off. They care about the snapshot of your balance when your statement closes. So you could be doing everything right and still have a score that says you're a risk. Here's what most people don't realize about utilization. The ideal number isn't 0%. It's somewhere between 1 and 9%. You want to show that you're using credit, but barely. It's like the system wants you to demonstrate that you can be in debt without actually being in debt. It's rewarding the performance of using credit rather than actual financial health. The third factor is length of credit history at 15%. This is where young people get absolutely crushed. You can do everything right, but if you're 22 years old, your credit history is short. There's nothing you can do about that except wait. And while you wait, you're paying higher interest rates, getting denied for apartments, and generally being treated as financially untrustworthy for the crime of not being alive long enough. This is also why financial advisors always tell you to never close your oldest credit card even if you don't use it anymore. That card's age is helping your score. Close it, and you're throwing away years of history. The fourth factor is credit mix at 10%. The system wants to see that you can handle different types of credit. Credit cards, car loans, mortgages, student loans. Having a variety shows you're experienced at managing different kinds of debt, which, again, isn't really measuring financial responsibility. It's measuring how good you are at playing the debt game. The fifth factor is new credit inquiries at 10%. Every time you apply for new credit, your score takes a small hit. The system interprets shopping around as desperation. So if you're trying to get the best rate by applying to multiple lenders, you're actually hurting your score in the process. Now here's where the psychology comes in. And this is what really frustrates me. The credit score system creates a feedback loop that keeps people trapped. If you have a low score, you pay higher interest rates. Higher interest rates mean higher payments. Higher payments mean less money to save. Less money to save means more reliance on credit. More credit usage means higher utilization. Higher utilization means a lower score. See how that works? The system punishes you for being in a difficult financial situation by making your financial situation more difficult. It's not designed to help you climb out. It's designed to extract maximum value from you while you're struggling. And here's the psychological trick. Because your credit score is a number, it feels objective. It feels scientific, but it's not. It's a model built on assumptions about what makes someone creditworthy, and those assumptions bake in all kinds of biases. Research has shown that credit scores correlate with race and income in troubling ways. Not because the scores explicitly consider race, but because the factors they do consider, like length of credit history and credit mix, are themselves influenced by systemic inequalities. If your parents couldn't help you build credit as a teenager, if you grew up in a community without good access to banking, if you faced any of the countless barriers that make building credit harder for some people than others, the score reflects that. But we treat the number like it's measuring something inherent about you as a person, like it's measuring your character. Like people with high scores are somehow more trustworthy or more deserving. Now look, I'm not saying credit scores are useless. From a lender's perspective, they do predict default risk with reasonable accuracy. The model works for what it was designed to do, but we've taken this narrow predictive tool and turned it into a comprehensive judgment of human value. and that's where the damage happens. So, what do you actually do about this? Step 1. Check your credit reports, all 3 of them. Equifax, Experian, and TransUnion. You can get them free at annualcreditreport.com. And I'm not talking about checking your score. I'm talking about reading the actual reports. Look for errors. Roughly 1 in 5 credit reports contains an error, and some of those errors are significant. Disputing inaccurate information is one of the fastest ways to improve your score. Step 2. Understand the utilization game and play it. If you use credit cards, pay them down before the statement closes, not just before the due date. Set up a reminder a few days before your statement date. Get that balance below 10% of your limit. This alone can boost your score significantly within a month or 2. Step 3. Don't close old accounts unless you have a really good reason. That old credit card you never use, keep it open. Maybe put a small recurring charge on it so it doesn't get closed for inactivity. That length of history is helping you. Step 4. If you have thin credit, consider becoming an authorized user on a family member's card. You don't even have to use the card. Their payment history and credit limit can start appearing on your report. Just make sure it's someone with good credit habits, because their mistakes will hurt you too. Step 5. Space out credit applications. If you need to shop around for a mortgage or auto loan, do all your applications within a 14-day window. The scoring models will treat multiple inquiries for the same type of credit as a single inquiry if they happen close together. But if you spread them out over months, each one hits your score separately. Step 6. Consider using credit builder products if you're starting from scratch. Secured credit cards, credit builder loans, these are designed specifically to help people establish credit. They're not scams, but they are businesses. Use them strategically and don't pay more than you need to. And step 7, maybe the most important one, stop internalizing your credit score as your self-worth. This is a game. It's a game designed by corporations to measure how profitable you are to them. A low score doesn't mean you're a bad person. A high score doesn't mean you're financially free. Some of the most financially stable people I know have mediocre credit scores because they just don't play the game. They pay cash for cars, they don't use credit cards. They're technically invisible to the credit system despite having their financial lives completely together. On the flip side, I know people with 800+ scores who are drowning in mortgage payments and car loans they can barely afford. The score said they were trustworthy enough to get those loans. It didn't say anything about whether those loans were good decisions. Here's the thing I really want you to walk away with. Your credit score matters, but only in specific situations. When you're borrowing money, or when someone is using it as a proxy judgment of your reliability. In those moments, yes, you need to know your score, and you need to optimize it. But outside of those moments, it's just a number. It doesn't measure your financial health. It doesn't measure your responsibility. It definitely doesn't measure your worth as a human being. The system wants you to be anxious about your score. That anxiety keeps you engaged. It keeps you checking apps. It keeps you paying for monitoring services. It keeps you in the game. So play the game when you have to. Understand the rules. Optimize where it makes sense. But don't let a 3-digit number designed by lenders to measure lending risk define your financial identity. Because here's the truth. Financial freedom isn't about having a perfect credit score. It's about needing credit as little as possible. It's about building wealth, building savings, building security that doesn't depend on some algorithm's opinion of you. Your credit score might be quietly making your life harder right now, but with the right knowledge and the right strategies, you can stop letting it control you. And honestly, that's when you start actually winning. I'll see you in the next one.